Thanks, Mary. Appreciate the warm welcome, and thanks everybody for joining us today. We are going to go through a lot of material pretty quickly, which I know can be difficult to digest. But as I'm just mentioning in the chat, if there's anybody wants some written materials or a copy of a select number of relevant slides, we can probably flip those out through Mary and by our after this presentation. We are more than happy to have questions come in along the way. You're welcome to fire them into the chat. It's probably the easiest way. And then while I'm blabbering on, Maria will happily interrupt me and to let me know that there's a question that's relevant to what we're discussing at the moment, or if it's something that we'll address later, then maybe let it wait for a bit. But either way, fire away the questions because I'd much rather have a conversation than just ramble on about the material. So as I said, we are going to go through it fairly quickly because it's a lot to cover. And so if you want us to slow down or hit the brakes and go over something a little bit more, just pop it in the chat or unmute your mic and ask us to repeat. So with that, I will see if I can get this to share. There we go. Okay. So we are, don't need that notification. That's great. So we are going to talk today mostly about the disability tax credit and the registered disability savings plan. They're two interlaced components of disability finance. They do represent a small component of the greater financial picture. And we're always apt to say that it's dangerous to look at just one area of finance in isolation. You should always examine any key component of finance in the context of a greater financial plan or the entire financial picture, which you'll see as we go through this why that's important. But for people who do understand their financial situations thoroughly and are looking for information, I hope that this provides you with what you need. Or anybody who's looking for more, we can always have a conversation here today or offline at another time. So with that, I'll jump right into it. And straight from the CRA's website, what is the disability tax credit? It's a non-refundable tax credit, meaning unlike contributions to in our RSP, you can't go below zero basically to get money back on your tax return. But it means that you can contribute, you can deduct certain expenses from your tax liability to the point where you bring your tax to zero, not beyond. So it is there for persons with disability or their supporting person to help reduce the amount of income tax they may have to pay. The purpose is to provide for greater tax equity by allowing some relief for disability costs, since these are unavoidable expenses that other taxpayers don't have to face. Basically, what that means is for this year, thanks Maria for updating for 2022 numbers, because they've just sort of wrapped up as we head into 2023 tax season. This is what you're allowed to write off, almost $9,000 now for adults and just over $5,000 for minors. A key component here in what we're going to talk about today, as I said, we'll see the interlacing of these two things, is that the disability tax credit and the RDSP work hand in hand. And the disability tax credit is essentially the gatekeeper to the RDSP, which comes with the Canada Disability Savings Grant, the Canada Disability Savings Bond, which we'll get into, Maria will discuss in due course. So what does the application process look like for the DTC? It's about the person who has the disability or disabilities. It is information about the person claiming the tax credit. They may not be one and the same. Certainly for case of caregivers or parents who are looking after minor children, adult children, doesn't really matter. Sometimes the tax credit is better in their hands than it is in the hands of the individual who is injured, depending on what their tax exposure is like and how much money they're earning. It considers the expenses that other insurers, OHIP, that they don't cover. So you're basically looking to get a deduction for out-of-pocket medical expenses. And as I mentioned, we're looking to see who's paying for these expenses, because again, that's relevant to the story of the disability tax credit. And it's often best in the hands of the person who has the highest tax bracket, because you might not only reduce their tax, but bring them down a tax rate. You can have previous tax returns adjusted. So, and we see this a lot in the world of personal injury. Someone was in a motor vehicle collision 4 or 5 years ago. They haven't settled their file, but they've had these expenses. The insurer is paying for some, but not for everything. How is all of that working? And again, in the case of parents or supporting loved ones, all of that can be adjusted retroactively. And there are 3 ways you can do that. You can have CRA do it. You just check the box and say, please adjust my past returns to the date of loss. Or I'll do it myself and show what expenses would need to be claimed. Or you have an accountant do it. And not just any accountant, of course. You want someone in all cases of financial services, advice, planning, investment management, account strategy, accounting, all of those things. If you're going to hire somebody in to do those jobs, you want to make sure that they have experience in the world of disability finance. And we'll go into why in due course. Part 2 of the application is to be filled out by a medical practitioner, a treating medical practitioner. So again, in the world of personal injury law, it's not always an assessor. You need to have a treatment component to it. And if you are not getting the kind of treatment from the right medical professional, then you might consider doing so. And we'll get into that momentarily. This could be your family doctor, your general practitioner. It could be a nurse practitioner, an OT, psychologist, etc. And what they have to do is speak to the areas of impairment. And anybody who's been down the road of applying for a catastrophically impaired designation on the insurance side of the space, you'll know that, or you may have heard the terms marked impairment or whole person impairment. Now those are, and catastrophic, of course, those are all terms used by the insurance companies and the world and personal injury lawyers, of course, but they don't exactly translate to CRA. Now, CRA has the equivalent, but they're not exactly the same words, and it's not automatic. Just because you've been deemed catastrophically impaired by the insurer does not mean you are catastrophically impaired as far as CRA is concerned. And there's a load of history behind that, with different governments sort of tweaking the rules that we don't need to get into because that would be boring. But that is important to understand. So you are not going to be automatically approved for the DTC just because you've been deemed catastrophically impaired by the insurance company. So when they look at this, they will look for areas where you are markedly impaired, meaning more than 55% in the insurance world. I think, Maria, you can correct me if I'm wrong. If it's the same percentage in CRA's world or not. But the other area is to say that you're substantially impaired in 2 or more areas. So you can be markedly impaired in 1 or substantially impaired in 2. Or go back to this concept of whole person impairment, meaning significantly impaired in many areas of life. And they're listed here: vision, speaking, hearing, walking, going to the bathroom, feeding, dressing, mental functions for everyday life. You require life-sustaining therapy. That's pretty much a slam dunk for this, of course. Or a cumulative effect of significant restrictions, which is what I was alluding to earlier. And it's important to know that if you're going to use an occupational therapist to fill out part of this form, they're only allowed to speak to walking, feeding, dressing. And in the world of brain injury, because we know that, as we've often said in this space, that brain injury can be seen or deemed to be the invisible injury, it's important to know that you really do need the right medical professional to speak to this. And in our experience, that's usually the psychologist or treating psychotherapist with the relevant qualifications. So social workers don't usually clear the bar. You want to be seeing a psychologist or psychiatrist. I know in the world of psychiatry right now, it's almost impossible to get a treatment. They're mostly doing diagnosis and then referring people back to their family doctor. All of this is sort of, it's the second pandemic that came out of the COVID pandemic, which is the mental health pandemic. and the world of psychiatry is overwhelmed by it, which is why it's now falling back to GPs who are also getting overwhelmed by it. So it's very difficult to navigate this space. But psychologists, particularly if you're getting the insurance company to pay for it, because I know psychologists can be expensive, if you're getting treatment in that space, they're typically very good at filling this out. Now, that may be with a bit of coaching from you, or sometimes we do this for our clients, where we'll explain to the psychologist the kind of language that they have to use and the kinds of areas to examine to get that substantially impaired in two, or that cumulative impairment across life. And again, in the world of brain injury, that tends to be sometimes connected to anxiety, or memory, or focus, or executive function, and how that causes somebody with this injury to take longer to do things, or to be restricted on several days where they can't. And anxiety is a big example of that. If you're suffering from anxiety and you can't get out to go to the grocery store, then now we have that cascading effect into the world of feeding yourself. So that will help you qualify, and the doctor needs to speak to that. So it's important that the language that the doctor uses is digestible, and it outlines the effects of the impairment rather than the diagnosis. So it does no good to have a neurologist say there's scar tissue, a lesion and surrounding scar tissue in the frontal lobe. CRA doesn't, I mean, it's effectively being reviewed by non-medical people, so they don't know what that means. But what they do would understand better is if either the neurologist or the psychologist says that because of that lesion and scar tissue in the frontal lobe, that the patient has significant impairment in executive function, and often takes 3 times as long to make a decision as somebody who does not have a TBI. So, or somebody who's not disabled. So that is the key component. When they kind of use that language, your chances of success in this space go up immeasurably. It's that speaking in terms of diagnosis that's just going to cause this to be delayed, or as you'll see, there are different categories. You may get approved for a temporary category, which is not ideal. So the other thing is that duration is one of the areas that's often overlooked, and it is mandatory on the form. How long is this expected to last? Because again, it can affect the length under which the disability tax credit is approved. So the process can take anywhere from 1 to 6 months. In the old days of submitting by paper copy, and lots of people still do that, and there's no problem with that. Lots of doctors prefer the paper copy. They don't want to deal with the digital form, and that's fine. You just have to be mindful that this can take a while, and you can have that form sit on your doctor's desk for a while. It can get mailed to the wrong place. A lot of people have sent this to CRA offices in Ottawa, and it doesn't go there. It has to go to the correct tax center, which is connected to your postal code. So for some people, that's Summerside, PEI. Some people, it's Sudbury. I think Winnipeg is another one. So depending on where you live and what your postal code is, it will tell you which tax center to send the form to. And if your doctor is going to send it for you, I highly recommend getting the envelope pre-addressed, because again, doctors who don't deal with this every day might make the same mistake of just sending it to CRA in Ottawa. Or if they're good, they'll give it back to you and let you send it, because you want to keep a copy of it anyway. So if your doctor is going to send it directly, ask them to photocopy it before they do, so that you can have your copy on record. Now, CRA may request further information. And again, this is why we're concerned about lag time and turnaround, and doctors didn't say things quite to the extent that they should have, which is very common in this space, and very common in the world of personal injury law and assessments, because doctors can be a little wishy-washy when it comes to making a definitive statement. I don't know why that is, but they tend to say, well, in my opinion, or it is my view that. What we always tell the doctor, and you can too, ask, of course, is to be very clear and definitive in language. Don't sort of say opinion or maybe it might and it could be and I don't know. And that just waters it down and it really reduces it. It reduces your chances of being approved indefinitely. So you can be approved 1 year, 5 years, 10 years. And that's another thing to be very mindful of, that if the language isn't strong enough, and in some cases it doesn't need to be. In some cases, in the world of ABI, and certainly in milder cases, you might get approved for 5 years, and that is the correct approval. But for most who are seriously injured, of course, indefinitely is where we want to get to because of the advantages that come with the Registered Disability Savings Plan. If you are approved for a shorter period of time, you do apply for renewal as you draw to the end of that time. And again, whether you're being treated by the same doctor or treated by a different doctor, you may go through the coaching process again, which is fine. Or again, the doctor could call us, I guess. There aren't too many disability finance specialists out there who will coach doctors. So if there are other ones and you found somebody, great, but that's an important thing. If you don't want to do it yourself, make sure that somebody is coaching that doctor on what to say. And again, asking politely, can you please use the correct language? So what are the deductions that you get? There is a page on the CRA website. I'll see if I can pop it into the chat here.
I've got that, Daniel. Thanks.
You've got it? Okay, great. Thanks, Maria. I've gone in the, oh, good. So this is why I say, again, using somebody, or particularly an accountant in this case, who has a very good experience in the world of disability, because you want to use somebody who knows that there are a lot more areas than just what you see on that last line, which is eligible medical expenses. So the eligible medical expenses are great, yes, and that's what most people who DIY their tax, they take a do-it-yourself approach, that's where they tend to focus. But there are other areas where there are additional deductions for people with disability. So it's important that you're familiar with all of them, or that you're working with an accountant who is. And again, particularly in adjusting past returns. One other thing that's kind of connected to this world that most people overlook is that there's the Ontario Community Support Program. If you're a low-income senior, a person with a disability and needs, such as those in supportive housing environments or community-based independent living programs, you can get paid or subsidized delivery of meals and delivery of medicine and other necessities. And again, this is directly correlated to what we're talking about, but I like to bring this up because it's something that a lot of people don't know about. So with that, I'm going to hand things over to Maria, who's going to go through RDSPs with you. I will watch the chat. So if anybody has questions, we can dig right in.
Thank you, Daniel. Thanks, everyone. So what is the RDSP? Well, the RDSP was created because it needed to replace, in some instances, an RRSP, the Registered Retirement Savings Plan. So the government realized that people with disabilities may not have the ability to accrue contribution room within the RRSP, and thus lost out on that tax-deferred growth. So they created the RDSP. It's designed to replace the RSP and promote long-term savings. Okay, the grants and bonds are there to help offset some of those increased costs associated with the disabilities that Daniel mentioned earlier in the presentation. Now, getting this set up is very important. It's one of the most important things we're going to talk about today, and you'll see many reasons why as we go along. We want those grants and those bonds to start right away. We want to collect them as quickly as possible, but we also want to have those grow for as long as possible. This is a great account to have long-term savings, and then therefore potentially go after longer or higher rates of returns. Now, household income, I will mention the grants and the bonds are based on household income, and that does change at age 18. So you do want to be conscious of that and how quickly you can collect that and at what time periods. I did mention this is a good place to pursue higher rates of return because you have that long time horizon. And Daniel had mentioned this earlier. Again, you do want to incorporate this into a greater financial plan. You'll see a few reasons why Some of them, you do have to collect these grants and these bonds in a strategic way, but you also have the ability to use this account to roll over other accounts and avoid some estate tax and inheritance consequences. So we'll get into that. So some of the benefits, all earnings grow tax deferred, not tax free. So unlike the registered retirement savings plan, where you contribute and you put money in and that you deduct from your taxes, the RDSP, all the money going in is after tax dollars, okay? But it does grow tax deferred. There's a lifetime contribution limit of $200,000. Okay? The grants, there's up to $70,000 that the government will actually put into this account, okay, for each beneficiary. And there's up to $20,000 the government would put into this account in bonds. Now, in order to collect those grants, you do need to contribute every year. The grants have a matching program. So you put money in, the government puts money in. So we can see the lifetime limit of $200,000. If we were to put $200,000 in today, we can no longer contribute next year. Okay, we hit our max. Therefore, the government will not match next year. Okay, so you want to be able to leave room in there so that you can continually contribute and the government will continually match those contributions. The account actually may benefit from losing some government benefits, which are income or asset tested, so like ODSP. We can get into that if that's relevant for anybody's situation, but it is likely an exempt account in regard to that government benefit. Now, to set up the RDSP, the beneficiary must have a valid social insurance number, and the holder must also have a valid SIN number, and they may be different people, as Daniel had mentioned. The disability tax credit, so the beneficiary must have that approved. The beneficiary must be a resident in Canada and age 59 or less at time of opening. So you do want to open this account before age 59. But I'll tell you, you do want to open it well in advance of that because you can only trigger those grants and those bonds up to age 49. Okay.
Maria, can you explain the difference between the beneficiary and the holder?
Yes, so the beneficiary is the person who is eligible for the disability tax credit. Okay, that's the person with the disability, with the impairments that are affecting their everyday lives. The holder is the person who opens the account. So this person must be over the age of 18 to legally open a financial account. They must also have a social insurance number, but they don't necessarily need to be the person claiming the disability tax credit. So you can have grandma as the holder of the registered disability savings plan. You could have the grandchild as the person with the disability who is eligible for a disability tax credit. And you can have the mom claiming the disability tax credit. Okay, so the mom provides care, has the tax deductions. Grandma can actually open the RDSP, and the grandchild is the beneficiary who is disabled. Now, I'd mentioned the contributions, they're not tax deductible like the RRSP, okay? And they can be made until the end of the year, which the beneficiary turns 59. Okay, again, until we reach that $200,000 maximum or the beneficiary has passed away. Now, there's a 10-year timeline, and this is why I said getting this open right away is so important. There's within the last 10 years, so if you do want to withdraw funds from this account, the CRA is going to look at the previous 10 years. If the government has put anything in, any grants or bonds within that 10-year period, there's likely going to be a clawback. Okay, so we want to collect everything as early as possible, contribute, collect grants, collect bonds, so we can allow 10 years to pass before you do need to use some of these funds. After age 59, the income payments start automatically. So you can see that government grants and bonds are triggered before age 49. And the government has reverse engineered this. So they want you to collect everything before age 49, 10 years pass, and therefore automatic payments start and there's no clawbacks at that time. Okay. I also had mentioned that the bonds and the grants, they're based on beneficiaries' family income, and I'll get into those details now.
Quick question on that. Can you contribute to an RDSP between the age 49 and 59?
Yes, so you can contribute to the RDSP after age 49. It will not trigger grants or bonds at that time. Okay, so if you do come into some money and you do want some tax deferred growth, or you do want to shelter that for government benefit preservation, you can contribute to this account. Another reason why someone may contribute to this account is for rollover purposes. So if a parent has passed away with RRSP funds, if they have an account, they can roll that sum of money into an RDSP for their child or dependent, but that counts towards the maximum of $200,000. Okay, so if you anticipate having an inheritance that's held within an RRSP or a RIF, some estate planning can be done to tax shelter and shelter the tax deferred transfer of those funds.
And another question, can you contribute after age 59?
No, you cannot contribute to the RDSP after age 59. So think of it as when RRSP turns into a RIF, you can no longer put money into the RIF, you can only take money out of the RIF. Okay, so at age 60, that's what happens with the RDSP. They don't change the name, they just change the function.
Give me 1 second. I've lost my screen and the Zoom controls are preventing me from getting it back.
So after age 60, yes, you're not able to open the RDSP at that point. Now with the grants, it is a matching program. So for family income, if a child is under age 18, family income includes parental income or any guardian income. Okay, after age 18, family income is their income and or their spouse's income. Okay, if that income is less than $106,000, if the beneficiary or holder contribute $1,500 into the account, the government will put in $3,500. Okay, based on matching. If the family income is over that $106,000, then the government will put up to $1,000 in there, matching 1-to-1. So you put 500, the government would match 500. Now we can look back. So Daniel had mentioned you could be approved for a disability tax credit from say 2018 to 2028. So if we open the RDSP today, we can reach back and collect grants and bonds for 2018, 2019, etc., but only 2+ current years at a time. Okay, we can't collect everything all at once. So again, we do need multiple years to be able to collect and catch up on those past or missed grants or bonds. Okay. With the bonds, the nice thing is you don't actually have to contribute in order to be eligible for these. So if you just open the account, submit the forms to the government, which the financial institution will do on your behalf, the government will look to see when you were eligible, what your income was, and they will just put in $1,000 each year that you were eligible. Now, the $1,000 is dependent on income. So family income less than about $35,000, $34,863, they'll put in the entire $1,000. If family income is between about $34,000 and $53,000, they're going to prorate that. And family income over $53,000, then you're no longer eligible for the bonds, but you are eligible for the grants. Okay. Now, these bonds were put into effect in 2018. So you can go back a certain number of years, but up to 11,000. Okay, so again, trying to get this done and put in place right away. Now, the RDSP and the disability tax credit not only is one the key to open the door to the other, but they work together nicely. So taking full advantage of the deductions from the disability tax credit might look as follows. So if we had 4 years where we had the federal deduction amount, provincial deduction amount, that could result in a return of over $1,500, right? $1,600, $1,631, $1,657. And you'll notice that that $1,600 is over what we need to contribute to capture full grants from the government. Okay, so we need to contribute $1,500 each year to capture maximum money from the government. Okay, so if we redirected that into an RDSP, the next slide is going to show us what that might look like. So in each of those years, we've redirected those tax savings. So this was not money out of pocket. This was money that we were able to receive because we used the disability tax credit deductions. Okay? So we redirect $1,500 each year. If we could collect the grants and full bonds, you'll see that with a growth of just 6%, which is about a balanced, just over a balanced portfolio at this point, the total contributions were $6,000, nothing out of pocket. The value could be up to $27,000 in just 4 years. So you can see that this type of account with personal contributions, with government contributions, and some growth could really make a difference in someone's financial situation in just 4 years. But we can see over 10, 20, or 30 years what this could really mean for somebody. Now, there's 2 types of payments from the Registered Disability Savings Plan. There's disability assistance payments, which can be made at any time. Okay, so at whatever point in time the Registered Disability Savings Plan is open, you can request a payment from that plan. Now, this is where that 10-year timeline comes in. Okay? If there is any funds in there within those 10 years, it's likely that the government is going to claw back $3 for every $1 that you took out. Okay, so it may not be advantageous to take money out of this account. Okay? The PGAP just means that it was primarily government funded. Okay? And a non-PGAP, if you look in those 10 years, if there's no government contributions in there, there will be no clawbacks there. Okay? There are minimums and maximums. We can get into those mathematical calculations if anybody would like. We can dig into that. But in general, in any given year, you're not able to take out more than 10% of that fair market value. Again, if it was primarily government funded, if it is mainly your funding into that program, into the account, then there's more flexibility there in how much you can withdraw. Now, the lifetime disability assistance payments, those start at age 60, and there's a nice formula there to calculate what that payment would be. So they look at the fair market value or the amount in the account. They look at your age, they do some more calculations, and they come up with an annual number that you will automatically receive from the account. Part of that will be taxable, part of that will not be taxable. Okay. Primarily government assisted plans. I touched on this. We do have a lot to get through. So if this is relevant to somebody, we can come back to this slide. But I don't want to spend too much time on the mathematical formula that the government or that the CRA uses to calculate these different payment structures. But again, the key takeaway is you do want 10 years to pass before you need those funds. Okay, or we are subject to a clawback. And that's the assistance holdback amount, is with the amount in there from the government over those 10 years, that's the amount that they could claw back. Okay, so there's a number of things that are great about the RDSP, like the free money from the government, but there's a few things that could go wrong. And I'm gonna pass that on to Daniel. He's doom and gloom. I'm, sunshines and rainbows. So Daniel, what could go wrong here?
Yes, I'm always the morbid guy. You should sit in on my estate planning presentation. It's really gloomy. But probably the most important area of financial planning is estate, both from parents leaving money to you, you leaving money to children or your loved ones or loved ones. It could be Uncle Joe and Aunt Susie are going to leave you money. It really does depend. That is a very important area. We'll touch on it a little bit today. But one of the questions before I jump back in here on pitfalls is what portion of the RDSP payment is non-taxable? It would be the amount that you contributed. So as Maria touched on, the payment that comes out of an RDSP is a combination of government grants, growth, meaning interest or return on investment, and principal. And principal is the amount that you put in. So that's why, as Maria was going through it, there are kind of different categorizations of an RDSP at the end of the day when you go to draw money from it. And the government's going to look at the account and say, who put more in there, us or you? And the calculation of how that payment that comes out, because when we talk about withdrawals from the account, it's actually a payment, because this is such a special account that the government's going to take a chunk of the money that you need to take out or that you want to take out and say, this much is how much you put in, this much is how much we put in, and combined, this is how much it grew by over the years. And that's not a calculation that any one person would want to try to do themselves or even get into and argue with them about. Typically, that's their decision, and they're going to look at that and calculate it and tax you accordingly. So that really has a bit of ebb and flow, because if you put in more than they do, you've got a little bit more leeway, obviously, because the bigger portion of the payment that comes out is more of your own money that you contributed, after tax dollars, as we're apt to say in the world of tax. And then the portion of that payment that is taxable will be smaller. Okay. And that's where Maria was going in, and that sort of depends on what the government put in. And that's why you might actually be able to take out a little bit more or a little bit less. All of that kind of gets factored in at the time of withdrawing. But the key thing to remember is, don't start taking money out of this account until you've stopped contributing for 10 years, because you don't want to get into that clawback. Oops, I jumped ahead of myself. Okay, so what could go wrong? We've kind of touched on this, though. I think Maria did a great job in speaking that there might not be enough time between your age today and age 49 to capture all the benefits of this account, because, as Maria said, you can only reach back 2 years. So this year, back 2, and then next year and back 2 more. If you've got, 10 years or 6 years or 8 years or whatever it is, and again, something we see very commonly in the world of personal injury law, because when a person is injured in a motor vehicle collision, you don't start thinking about future finances necessarily right away. But when we get involved with clients who are relatively recently injured, we start to implement a lot of these things to get all the ducks lined up. Even if they're not super relevant or super beneficial out of the gate, at the very least, we may start triggering bond income. And bond income that goes in there, $1,000 every year, compounded with growth, there's nothing to sneeze at. But again, that might be dependent on how old the person is. Every case is very different, has sort of different tricks of the trade, depending on age and living situation, household income, all of that. So that's very important to understand, again, from the reaching back perspective, is that you've only got so many years that you can capture per year. So if you're 47 years old and you were injured 8 years ago, you're not going to have enough time. So we want to be able to make sure that we do the best we can under those circumstances, and to not over contribute either, because, as the next point says, you may not have enough time to park the assets. You may need that money before 10 years from 2 years from now, right? So that kind of idea. The other mistake that we see, and this is more often done when people are working with financial professionals who are not disability finance specialists, they over contribute to the account and don't leave enough contribution room to trigger those grants, or to have our RSP or our ESP rollovers. So again, in the case of a personal injury file, we saw someone who settled their accident benefits, tort was to follow, but also had a sale of property as well. And he had about $300,000 or $400,000 that he wanted to invest. And he got the letter from the government saying you're RDSP eligible. He walked into a bank and said, what does this mean? And the financial advisor Googled it in front of him and said, oh, well, let's put $200,000 in this account because it'll be tax sheltered. not knowing that now he could no longer contribute and capture the grants. So the other thing is he had ailing parents with money in an RRSP. When they died, unfortunately, we cleaned this up before this happened, but when they died, there would not have been enough room to pay that RRSP into or roll it over into the RDSP, which means not only is it exposed to a state administration tax, but the amount of contribution that could have been put in the RDSP is added to the testator, which is the term we give to someone who's passed away and is leaving assets behind. The testator's income tax level would have gone way up because they would have made money off of pension and other things throughout the year, and then collapsing the RRSP into the estate puts them up to the highest marginal tax bracket, meaning more than half of the money that they could have left to this person was gone to income tax. So that is a major mistake. And it could be the difference between $100,000 going in net or $50,000 going in net. And that's a big cost to a mishandling of this account and this strategy. Which brings me to the next and last 2 points on the slide. This is unfamiliar territory for most financial advisors out there. If they don't have any experience in this space, it's almost inevitable that they're going to make a mistake. And again, so I want you to have this information if you're going to be taking the do-it-yourself approach, or again, to work with somebody who is a professional in this space with lots of experience. The other thing that we see go wrong frequently in this space is that ODSP, people who are dependent on ODSP, they're not using the RDSP to the extent that it could be to preserve ODSP benefits. And it is really important. So sorry, my phone is binging away here, inbound emails. But what happens in this space is that, and again, I'll use the personal injury example. If you settle your accident benefits file and in that component of the ABs, there's a component for income, meaning an income replacement benefit, or sorry, I'm going to just mute this so that it stops because it's driving me nuts and distracting me. So bear with me one moment. Sorry about this. There we go. That should stop the blinging. So with ODSP, we see sometimes that people are not putting away the right components of their settlement. It can also be on the tort side of things with the future loss of income or past loss of income. Or, as Maria has been very skilled at doing and has done so for a couple of clients recently, where she has taken some of that non-exempt money, explained the strategy to ODSP. And the beauty about ODSP, I know most people think they're evil ogres that live in ivory towers, but they can be very accommodating. And as long as we're speaking their language and showing them how this strategy brings offside scenario onside with their rules, they're usually very accommodating. But you have to explain it in terms that are congruous with those rules and are not deemed to be ways that you're trying to be sneaky and hide money. Which we never do, because again, if you show them a legitimate strategy, you don't need to be sneaky about it. So it's really important. Anyway, in order to understand that, there are asset limitations. A single person limit's 40, 50 for couples. And that is on assets that are not related to care, future cost of care, or attendant care or medical rehabilitation benefits that come out of personal injury. So those are exempt, but other assets may not be. Principal residence is one that is. One vehicle per household is exempt. I touched on this with personal injury awards. It's something, again, that you want to take a deep dive on this, but also a Henson Trust is a very important component of the state. And again, we're touching a little bit on estate planning today, but there's a far deeper presentation that we can do in this area. But a Henson Trust is really important because it is intended for bequeathed assets or money left to you through an estate. And the way it works, and it sometimes gets very complicated when we have mom and dad, Uncle Joe and Aunt Susie, or brother Joe or Jerry, or some other family members who all say that if I predecease, my disabled family member, I want my assets to be left to them, but my family member is dependent on ODSP, so I don't want those assets to knock him or her off of ODSP. So the way that gets done is that all of those people need to have their wills sort of coordinated, meaning the first one to die creates the Henson Trust, and any subsequent deaths fund the trust, because you're only allowed one. And that's really important. So that takes care of some of the asset limitations on ODSP's regulatory rule sheet. They also have an income restriction, which is $10,000 per year for any source. There are other new additional categories that kind of meet certain circumstances that are probably too detailed to get into for one presentation. Again, something we could do an entire presentation on is ODSP, but not everybody here is on it. So we're just going to touch high level here. But basically, you can make $10,000. When it comes to investments, they do not differentiate between capital gains or dividends or interest or any of that like CRA will. But for ODSP, it's just whatever value is today minus what we call the adjusted cost, basically the initial deposit. That whatever that number is, if that's more than 10,000 in a year, they can knock you off or render you ineligible. The good news is they don't always knock you off the program completely. And for every dollar over 10,000, special exceptions apply, of course, they may only reduce your income benefit, not your rental subsidy, by 50% or 25% or 75, whatever it is. So again, being open and honest with them is usually the way to go. Now, you don't necessarily need to volunteer information. They do have to sort of catch you through audit. But how that happens can be pretty easy to deal with, again, so long as you're doing things the right way, which also may include future contributions to an RDSP. Now, when money comes out of an RDSP, if you are drawing down, obviously you start drawing down at age 60, prior to age 65, which is when ODSP cuts off. How that RDSP payment gets calculated is again a bit complicated, but it's sort of along the lines, like we mentioned earlier, how much of that payment is your contribution, how much is government benefits and growth, or government contribution and growth. So that's something, again, that you want to be mindful of for those years. Now, some people start contributing to an RDSP younger, and they are ready to start drawing down well in advance of 60. So if you're dependent on ODSP at that time as well, this is where things can get complicated, but too detailed to get into for today. When it comes to structured settlements, a structured settlement is an annuity product that is only eligible to people who've had a loss from personal injury or death. So it really is very much focused on the auto insurance space or motor vehicle collision space. But it is an option, an income tool for after settlement. And the way it works is basically you give a life insurance company, so not the auto insurer that you settled with, but you give a life insurance company a chunk of that settlement, and they will give it back to you in pieces plus a small interest component. And the way that works, because it's very difficult and they never show their cards as to how much is actually interest and how much is what you contributed. The way ODSP deals with that is they say, okay, we accept that there's some interest in that payment. We're not going to deem it to be offside. We're going to allow the structure to run until it pays back all that you put into it. So if you put $200,000 into a structure and it's going to run for 50, 60 years or life or what have you, the day it pays back that $200,000, from that day on, you are offside with ODSP. So if you are being forced to take a structured settlement, or you choose to take a structured settlement as part of an insurance settlement, you want to make sure that it is set up such that it doesn't repay the capital unless necessary. But if you can, set it up such that it doesn't repay the capital until age 65. And there are a few tricks to be able to do that, but again, too detailed for today. So one of the other things that you can do to sort of make some income that is non-exempt exempt is by acquiring medical services or items directly related to the injury. So if you have a brain injury with no musculoskeletal, no soft tissue injuries, you can't go out and say, "Oh, I need a bunch of massage," without being, I mean, they could challenge you on that. I shouldn't say you can't, but you could be challenged on that because it's not necessarily treatment related to your injury. But most of the time they don't get into it. I mean, the truth of the matter is they don't have the time for that kind of an audit. But if you're showing that you have medical services and items, chiro, physio, medical supplies, of course, anything that you're out of pocket for, that can help reduce. If you made $12,000 last year, you might be able to show that $2,000 of that went to those items, and therefore you're still back to that $10,000 limit. All right. Childcare also counts. All of these things, vehicle costs, repair, maintenance, you can sort of attribute some of it to that as well. So how all of that rolls out, again, very specific to every individual case. The other thing that's very important to note is that they will start evaluating you from the date of the settlement disclosure notice. So your net SDN, as we call it, is something that your lawyer needs to be mindful of if you are going to continue to receive ODSP benefits. And we do this all the time. We are constantly coaching lawyers on how to show the net SDN, or what we call the SDN in tandem with a statement of account. So if you want us to speak to your lawyer about that to ensure that you're in the best possible position to continue to receive ODSP, do let us know. It's definitely a case-by-case conversation. So estate planning, I've touched on this a few times. It is very important. As I said, I think it's the most important area. We want to make sure that the wills are properly worded. This is something that I mentioned before, that, you know, if you've got a bunch of different family members that are going to leave money, it's got to be constructed properly across all of the wills, because you do not want to create a non-exempt estate, or they don't want to create a non-exempt estate and compromise income from from ODSP. The other thing that becomes jeopardized with ODSP is sometimes you can be a non-monetary benefit, meaning they don't give you any money every month, but they still let you use their medical dental insurance, their coverage. And that sometimes can be worth hundreds of dollars per month. So very important that even if you tip the scales on assets or income and you can keep that, you'll be in a much better state financially. So each one of these can have, you know, pretty significant, obviously, ramifications and increased costs if it's not handled properly. I think we've touched on this, so I won't go over it again, about our RSPs rolling into our DSPs. Financially dependent benefits is obviously a key component there. Reducing taxes from income to estate administration is very important. That's critical. Inheritance should be properly structured in any case, you know, to ensure longevity. That's a very important thing. The best way to do that is, of course, through trusts. Trusts that can be done for inheritance or life insurance. There are certain limits for ODSP, but when they're set up properly, they may be very cost effective for that person to continue to receive benefits from a testator or from a loved one who's left you money. So very, very important to make sure that that's done properly. So I like this graphic to sort of sum all of this up. When we're talking about contributions to our RDSPs and tax strategy, all of that is, you know, tip of the iceberg. What the underlying investment strategy is also very important, because when we're talking about capital gains or interest or dividends and the investment security and risk, all of that is very important. And it can be effectively balanced out through account strategies. So if you've got a TFSA, you've got a non-registered account, somebody in the family has an RRSP, and you've got an RDSP, how all of these accounts work together to make your situation the best possible, it requires a skilled hand. And particularly when we're talking about multi-generational estate planning and all of that, and integration, of course, with other key components of the financial plan to ensure that you're in, as the outset was, talking about Maria's thesis, you know, the most efficient solution and the best possible place financially.